So we've learned that increases in capital per hour worked and or increases in technological change will both increase labor productivity, and that will lead to more economic growth. So one question that might come to mind is, where does the money come from to increase capital per hour worked and technological change? And that brings us to our financial system. We're going to think about the financial system perhaps a little differently than you have before, and try to make it a little more high level, a little more aerial view, if you will. So when you think about the financial system, there are various financial intermediaries, to use a generic term. Financial intermediaries would include banks, so you going into the bank and opening up a checking account or a savings account. It would also include you putting money into the stock market, the bond market, all of those lovely things that you learn about in finance class. So those are going to be our financial intermediaries. So they are a middleman of getting money from those who have it and don't need it right now to those who need it. So you have your savers, who are the ones who have money that they don't need to use right now, and they're going to supply money. Ooh, notice that word I just used. Supply, it's back. They're going to supply money into our financial intermediary system in any form. And we're just going to refer to all these different forms that the money could be saved as loanable funds. That's what I mean by high level or aerial view of things. So our savers are supplying money in there, and then there are people who need the money, and those will be our borrowers. All right. So what are our borrowers doing with these loanable funds? They are demanding the loanable funds. So yes, we will be drawing a supply and demand of loanable funds. That's what we want to master with this particular concept. So it's important to understand who's on the supply side, who's on the demand side. So to keep things simple, we're going to say that the supply side, the savers that are supplying, is basically going to be either your consumers or households, might be another word you would look for it. And we're also going to keep the government on this side. And then over on the borrower's demand side, that's going to be the businesses or firms or whatever words you want to use for them. And there is some simplifying in that assumption, because you are a household consumer, and I'm sure you, like most Americans, have borrowed funds on occasion, if not now, at least at some point in the future. So it is true in the real world that, consumers are on both sides of the market. But we're just going to keep it really simplified. It doesn't make a big difference as far as the conclusion of the model to have these sort of simplifications. So we're going to think about consumers being on the supply side. They earn income, they save some, they consume some. What we're interested in is that percentage for the loanable funds market. What we're interested in is that percentage they're saving. So whatever they're not currently consuming, they put into a bank, a stock, or a bond, and that's supplying loanable funds. Businesses are having to do investment. And here's the key thing. And I'm glad I mentioned the word investment, because this is where you're going to get confused. You, as a normal person, hear the word investment, and this is what you think. This is not what we mean by investment. When we say investment, we are referring back to that that was part of our GDP. So when we say the word investment, what you need to think about is businesses want to do investment. They need to demand loanable funds to make these investments. And consumers, households, have extra money, and so they're saving it. So we save it by putting it in the loanable funds market in any form. Don't care. We're not going to specify which form. They're going to supply it here so that businesses can demand it and do business investment. All right. So that's just important to get the lingo down on what we're talking about. One more word here before I show you some examples with the actual supply and demand curve, and that is to look at government. Different books, different models might specify differently how they want to handle government. What this book is going to say is that government is on the supply side. And that means that if the government is running a budget surplus, spending less than they take in, they actually have extra money, then they literally do have money to supply into the loanable funds market. So they increase the supply. If the government is running a deficit, which is what we're more used to, and they're spending more than they take in, we're going to show that as them decreasing supply. I have an exact example I'll show you, but I just wanted to go ahead and mention that we're going to keep government on the supply side, and the budget deficit or surplus will just be reflected in what that does to the supply side. Okay, here it is, our supply and demand of loanable funds. So remember that the supply of funds is your households or consumers, and we're going to say government as well. And then our demand for loanable fund is coming from businesses. All right, so our first scenario will be a change in the consumer's desire to save. And this happens sometimes in the business cycle. Perhaps they get scared of the future. They think that job losses are coming, and so they become more frugal, which means that they want to consume less and save more. Okay, so what we're saying then, much like we said way back in micro, when we have a demand curve and a supply curve, is those curves exist at a point in time, but if factors change, the curve will shift. So whatever amount consumers were willing to supply, so look at what this is, loanable funds. Dollars of loanable funds are going to be fairly low. You're saving a fairly low amount when the interest rate you're going to get paid is relatively low. And then as the interest rate goes up, you're willing to supply more. So right now our interest rate is very low, and if you put money into a savings account, you get almost 0% interest. And so this is kind of where we are in the real world. But if the interest rates were to return to a more normal level and nothing else changes, just a rise in the interest rates, we would expect to see people more willing to save and increase the quantity supplied. All right, so that's why it's an upward sloping curve, and that is our relationship with the interest rate. But what we're talking about here is something other than the interest rate changing. We're saying that people have a different preference, that now they have decided for whatever reason that more money needs to be saved. So how would that show on this graph? If they're wanting to supply more, so what we could see is that at any particular interest rate, they were willing to save this amount. Now they want to save more. At any one interest rate, they were willing to save this amount, and they're now wanting to save more. So what I'm describing is an increase in the supply of loanable funds. And so that is how we're going to be mapping the changes in consumers, in this case, desire to save, is by showing it's graphically an increase in the supply of loanable funds. And then what that would mean is, yes, there would be a higher equilibrium quantity of funds, and there will be a lower interest rate. This is our long-run interest rate that is sort of kind of beyond the control of the Federal Reserve. I'm kind of getting a few chapters ahead even mentioning that. But what we do see is that when things happen in an economy to encourage consumers to save more, this is what we would expect to see: lower interest rates and more funds available for investment. Now notice at the business side, they didn't change their demand for loanable funds, but they will be demanding a higher quantity of loanable funds because you've made the cost of borrowing less. And so generally, things that increase savings is considered a good thing, because if you increase savings, that's this increase in the supply of loanable funds, then you'll see a higher quantity invested. A higher quantity invested will lead to more capital per hour worked, and more technological change, and more labor productivity, and therefore more long-run growth. So you can see how all of this ties together. All right, here's another scenario. Cutting taxes on businesses. So businesses pay taxes on their income. If you were to decrease the amount that they're going to have to pay in taxes, you essentially have increased the return on an investment. So I was going to do an investment, and after taxes, I'm keeping, say, $1,000. Now you're taxing me less, so after the investment is over and the taxes are paid, I get $1,200. When you increase the reward to investing, then you're going to see more investing. And so the way we can show that is we are going to have an increase in the demand for loanable funds. So you would expect that, given that I'm now going to, the business, I'm now going to have more to show for an investment because you're taking less away in taxes, what you'd expect would be this increase in the demand for loanable funds. So now what we're going to have is a higher interest rate and, again, like from the last graph, a higher equilibrium quantity. So one of the reasons you hear a call for decreasing taxes on businesses is this idea we're going to have a higher equilibrium quantity, we're going to have more investment made, and therefore more investment is more capital per hour worked and more technological change and more labor productivity and ultimately long-run economic growth. Now, notice that when you achieved that through an increase in supply, like we saw in the last graph, we actually had a lower interest rate. When you achieve this increase in investment dollars by increasing the demand for loanable funds by lowering taxes, you actually end up with a higher interest rate. Just pointing it out. But both of these scenarios we've looked at so far do lead to more dollars of investment and therefore, presumably, more economic growth. All right, the final one we're going to look at is government deficits and, by implication, government surpluses. So what you have to understand is the book, has basically decided that you're going to show government savings or dis-savings as occurring on the supply. So if you had a government that ran a budget surplus, what we're saying is that they spent less than they took in. They have a pool of money that is available. And so in that sense, they are supplying loanable funds. If they spend more than they take in, they had to come up with that money somewhere. So they've essentially, with a government deficit, they've essentially subtracted from the supply of loanable funds. And that's what you end up with there, is a decrease in the supply of loanable funds. You will have a higher interest rate because there's less funds available for any level of demand there already exists, and therefore you will have a higher interest rate. You also see that we end up with a lower quantity of loanable funds, and so the existence of the government's deficit is actually reducing investment in the economy. And this is one of the reasons that you will hear people talk about government deficits in a negative way for the economy, that it is reducing the amount of investment that's occurring and leading to less capital per hour work, less technological change, therefore less labor productivity growth, and less economic growth. All right. The other reason you hear criticism for government deficits as far as lowering economic growth is crowding out. So crowding out is basically the idea, where did the government come up with this money? They spent more than they took in. It had to come from somewhere. And so we can see crowding out here in this graph because the existence of the government's deficit has reduced business investment. It has reduced consumption. I'll have to explain that one. And so if you remember, GDP is C plus I plus G plus NX. Yes, you increased G, but you essentially did it by causing C and I to decrease. How much is the crowding out? How significant is it? Is a matter for debate and something we can talk about more in a later chapter, but we at least need to introduce what's going on here. So where do we get the crowding out investment is we can see this movement along the demand for loanable funds. The businesses used to, let's just pretend this was a balanced budget to keep it simple. This used to be all business investment demand, right? That was how much they used to demand. But now that you've caused the interest rate to rise, they're only going to demand this amount. And so the businesses have essentially been crowded out. The quantity they're going to invest has been crowded out. At the same time, households are going to supply more loanable funds because you've increased the interest rate. So the quantity the households are willing to supply is higher and kind of needs to be higher to make up for what the businesses have taken, to make up for the government has taken by doing the deficit spending. And so when you increase savings, you by definition decrease consumption because all businesses can do, I keep saying businesses, all households can do with their income is consume it or save it. So if they're saving more, they are consuming less. And so you have this reduction along the quantity supplied and you have this reduction in the quantity demanded, and that's your crowding out. So that's considered another problem with government deficits. But anyway, just to wrap up this part of the lecture, if we have a government deficit, we're going to see this decrease in the supply of loanable funds. And if by some chance you have a government with a surplus, you would actually see an increase in the supply of loanable funds because you essentially have another party doing savings. So that will wrap up our discussion on the loanable funds market.